Thank you. That's better. Okay, welcome everybody. Welcome to the CPA Financial Modelling Discussion Group here in Sydney. We are about to get started. My name is Danielle Stein-Fairhurst. I'm a financial modelling specialist and I am the co-convener for this group. And we get together from time to time, not quite as often as we did during COVID. And every now and then we manage to run a session in person, which is fantastic. We have a handful of people here in the room and we've got lots more people online. So I'm very pleased today to introduce Ruby Liu. So I have known her for quite some time. She is a director at KPMG, Financial Modelling
Valuation
superstar, I was going to say.
Oh, I won't go that far.
I'll let you tell us a little bit more about yourself, but you are not going to give a formal presentation tonight, are you? You're just going to be something a little bit more informal.
Yeah.
I'll be monitoring the chat, and if anyone has any questions in the room, please raise your hand and feel free to interrupt. Ruby is very happy to be interrupted. Yes. I'll let you introduce yourself a little bit more and tell us more about your role.
Sure thing.
So I will hand over to you, and yeah, let us know online if you have any trouble seeing or hearing things that Ruby is showing us. So take it away, Ruby.
Thank you, Danielle.
Are you going to send the presentation to people?
Yes.
Yes.
I will send out the recording if the recording works okay, and also the presentation. I'll make that available for the people who registered.
Okay, hi, thanks Danielle. It's my pleasure to be here. And as I talked with Danielle, the whole idea is not really about I come here to teach people anything. It's more like I would like to use this forum to share what I know and learn. And then, it become a very interactive forum. So any questions, any thoughts, please just yell out. And I will always find, in the same time I sharing my thoughts and experience, I also learn from the group as well here. So for the people online as well, please just type in any questions or any thoughts you have, and we can just have a relatively informal session. So very quick intro of myself. As I mentioned earlier, I'm actually not an accountant. However, I always thinking accounting it's critical important for financial modeler. There's so many times, I have seen people have the balance sheet not balanced. So everyone knows what I mean when I say something like that for the modeler. So I actually studied applied finance at a university, and then I worked in multiple companies when I was young. Worked in banking, worked in some corporate in-house job, as well as worked in the government, basically the Queensland Treasury Corporation. And then I actually really start to use financial models from very beginning, doing a lot of scenario analysis, but doing the true comprehensive financial model learning and training is when I start my job in Sydney at a Corolity. So that is a specialist modeling firm at the time. And then we're doing model build, model audit, as well as the model training. So that's probably the first time I get more systematically, learning and using financial model for daily work. Then after Corolity, I basically got the opportunity, very honorably become the head of the KPMG Sydney modeling team. And we have roughly 8 people in the modeling team, and it's a full-time modeling work, literally. And we're doing the same thing, model build and model audit, as well as the model training for the more internal KPMG team. And then after that, I joined Transgrid. For people who in Sydney probably know Transgrid. It's an electricity transmissioner as their head of corporate finance. So during the time, I actually found financial model is extremely useful and important. But what even more fascinating me is how we use the model to make a decision. So a lot of times when we go into the board talking about the capital investment, you do all the model analysis underneath, but fundamentally you get the output, talk with the board and sharing about the our investment recommendation. So that's where I found valuation become quite interesting area for myself. So after transcript, I joined the KPMG valuation team, which is where I'm currently working at. So even I'm in the valuation team, I'm still using model a lot, although I probably don't build a model that often, probably, not like daily job. But from time to time, I'll say, oh, this current tool is too inefficient, or some of the things they gave me, and I'll basically say, this model is too ugly, let's just rebuild it. So either way, from time to time, I still hands-on to build the actual model, but most of the time, I'm more like a reading, using model to do analysis these days. So that's where today I'm keen to sharing some of the painful point where I see in the valuation team, when I see some model built by others. And that's time I will say, I wish the modeler build a model in a slightly different way. Yeah. So today, it's not going to cover all the best practice for DCF valuation model. It will probably just be a scratch of it, but I think it's a good start point. And again, as I mentioned, any of the thoughts and thinking, please, yell out as well.
So is this going to be this? Oh. So this is going to be all of the things you wish that modelers would do. Yeah.
Yes, to a certain extent. Yeah, and
Yeah.
also some of them, it's more like some of the like a key concept I found, like, people as a financial modeler know in the valuation field, maybe not that particular about that, but as a valuation practitioner, when you see the model, you actually prefer if the modeler knows that particular valuation concept and doing slightly differently. Yeah. Cool. So very quickly, agenda, so people know what we are talking about. And I was being told, actually not really being told, I think I read an article before, basically said human beings' brain, how we developed is we cannot, especially when we become adults, we cannot be in concentrate for more than 20 minutes. Otherwise, we start daydreaming or thinking about something else. So I was talking with Danielle, is this one will be 20-minute session? Danielle said, well, probably it will be longer than that. So that's where I really encourage people to, talk with me before, like any thinking, any thoughts, just, quote out so that we can be focused and make the whole session more interactive and interesting. So this is what we're going to cover tonight. So firstly, it's the intro, which we just finished. And then it's what is a good financial model. So this is based on my own experience. It's purely my own opinion. And then we're talking about the key 3 approaches we use for business valuation. And we just basically gave some high-level understanding of valuation, which I think most of people probably already heard of those approach. So I'll touch base on those ones. And then to the key point, which is the best practice for the DCF valuation model. And that one, I'll just go through a list of pain points or list of key concept clarification. I'll go through them. I need to say the slide I was prepared, it's quite high level. It's probably not the level normally you're expecting have a lot of like wordings. That's another thing I found is sometimes when you have too much wording in a slide, people will more driving the attention to the slide, they start reading the slide. So that's another thing. I just give people a heads up. There's probably, don't get too disappointed. There's not too much, information was being populated in the slide. So the first one is what is a good financial model? I may pause here if anyone want to share a view. What's your view about the financial model? And online one, please just type in. Otherwise, I'll use the typical technique about facilitator, appoint people. I don't remember the names, so I'll give the right to Danielle to pick one or two to share the view.
Any ideas what you would say user-friendly and flexible?
Thank you very much.
Yeah.
Thank you very much. Appreciate that. Any thoughts from the room and anyone from online?
I'll just say logical, left to right, top to bottom, inputs, calculations, outputs. Only to me seems logical, but I've noticed, so I see a lot of models what other people seem to think is logical or straightforward is not what I think is.
Yeah, no, definitely. So it's very like, it's very good. It's like logical, right, left to right, top down, and, input, output, reasonably reflect the reality and easy to use. Yeah, I
I
agree.
think the one thing is most important to let the audience or decision makers, they understand what you're talking about.
Yeah, exactly. Scalable. Oh, scalable is an interesting one.
Comprehensive, and in the sense that no, it considers, or it's more of a flow rather than when you have to juggle between the different sheets, and then like there's a flow that happens, and that's automatic, and well, you don't have to put in there's if I can say, like, very minimal manual intervention, or yeah.
Yeah, I know what I mean. I think it's similar like what you said. It's logically flow, so people can quite easily understand how the model works, the logical flows. So it's all valid point, yeah, input and variables are kept separate from the output. Thank you. I'm actually summarized into 3 elements, and I have to say, I agree, transparent, it's very important. I have to say this is only my opinion, but I actually quite, I believe those 3 key points to represent a good financial model. So the first one is meet the purpose. So when I say meet the purpose, I'm no mean like meet the model's purpose, meet the user's purpose. So a lot of times, when we talk with the client, this is a little bit like, I found is people don't really proactively listening what the client actually want. I'm a consultant, so sorry, I actually tend to say, listen to a client, but even for the in-house work, it's your internal client. So I found it's very important. You need to proactively listen to the client and try to use your past experience to predetermine what the client required. Even myself, from time to time, I will make the same mistake to predetermine what the client wants. So that's probably the first thing, is meet the model user's purpose. Because as a model developer, give example is one time, the client want us to building a Monte Carlo model, and the client specifically said, they want this one to be conducted without the macro, which we can touch base on that a little bit later. But our people very familiar with how to use macro to build a Monte Carlo model, and end up they have a lot of like a clash about what the client want and what our team actually familiar with. So the team actually spent a lot of time trying to convince the client to accept a model with Monte Carlo building in by a macro. So that's what I'm trying to say. It's like, sometimes you want to understand the client's underneath need, and don't try to use what you're thinking to override their actual need. So that's the fit the purpose, meet the purpose. The second one is user-friendly. When I say user-friendly, it actually covered fair bit, The first one is like you guys mentioned, input calculation sheet and output are separated. You have clear cell style. So for the input cell, it's in certain style, and you have, calculation cell. If the calculations refer to other workbook, you have a different style. And if the calculation is in the same workbook but different sheet, you have another cell style. And those ones are like, helping the model user to basically quickly understand your model and also understand how your model flow. And another thing is the presentation, because a lot of times I found one of the example my team built is they build a model, which is not bad, but the color they chosen, to be fair, it is very personal, the preference about the color. But the color they chose, I'm not even joking, the output color looked like a Christmas tree. And I really don't think that's a good thing. I always promote simple and not too many colors in the model, and try to not use like a big chunk of red as a background. Say if your company happily have the brand color, it's a red, maybe try to not use the red as the main color for the background, because when you're thinking about you open a financial model, all you see is all the red background. It's just quite, it's a lot. So that is presentation to be clean and simple, and I like to say beautiful of a model. So that is the second part, is the user-friendly. Yeah.
May I ask you, what's the reason, in your opinion, to use different color on a model?
Use different color?
Yeah, what's the purpose, in your opinion?
It's really just to, when you have the, I always, for the color-wise in the model, I always choosing a single main color. Like say, for example, if it's blue, the main color and all the main color scheme will be all blue. And then I may vary the color based on the blue to be like, maybe it's like a really light blue or really dark blue, or something like a purple, which is similar to the blue to a certain extent, or blue black, this type of thing, to separating a different type of cells. So for example, if I want people to clearly see, okay, for this color means the cells, it's the reference cell, it's pick up the information from a different workbook or from different sheet, so they can quite clearly see that. And another thing, purely for presentation, for prettiness, for the output sheet, you want to have slightly different color from time to time. And even for the chart, if you build a bar chart, you will have different chart for different legend, etc. So those ones is probably the main one. But I always will pick up a mainstream of the color, and then based on that color stream, then I will choose the rest of the color, which is all in the same scheme, but slightly different, just for the presentation. So that's the second one, user-friendly. The last one is the calculation speed. I know this one's a little bit trickier, and basically the middle purpose and the user-friendly have been covered by people in the group and in the room, and also a lot of people online talking. The one I want to highlight here is the calculation speed. In my opinion, if a model size, which I mentioned before, I think Danielle, we had discussion a while ago as well. If the model size earlier time, 10 years ago, if you ask me, in college, I'll say 20 megabyte, it's a best practice. But these days with Microsoft's, with technology development, I probably will suggesting 50 megabytes still work if you're building the model well. So there are a lot of ways to improve calculation speed. So for example, try to color the cells you are use. So sometimes, you have a header, the header just being dragging towards the end, like I think it's the XFD column. So that one, all those color of the format of the cell, it counts a memory of Excel. And another thing is try to minimize conditional format. Of course, I use conditional format a lot from time to time. It does help user-friendly, but depends on the size of your model, And try to, when you pick your formula, you always be more cautious. Try to avoid or minimize the use of the volatile formula. Data table is very volatile. If you build a small model, data table is very useful for scenario analysis. But if you're building a large infra transaction model, I will not use data table for sure, because that will slow down.
What kind of table?
Data table.
Yes.
Data table.
Yeah.
Maybe my accent. Data table.
Yeah.
So that's something, I will recommend. And for volatile formula offset, I use offset as well. But sometimes you find, offset is definitely volatile formula. And these days, you will find index match. It's not calculating as quick as summer if, I think. I can't remember 100% now, because in the old time when I was more like in the modeling team, we sometimes will use macro to count the calculation speed for certain formula. These days, that was, I feel like a last century's job. But at that time, I think, if you building, actually it's another way around, apologize. If you're building a lot of some ifs, it actually will slow down the model. But if you use index match, sometimes it's actually not impacting speed that much. And also Excel likes somehow I don't know why, Excel likes, like I give you two scenarios. Scenario one is Excel have a lot of the tabs, and each tab, the deepest tab probably have 100 rows or 150 rows. That's the scenario 1. Scenario 2 is Excel have 2 sheets, 2 tabs only, and each tab have over 5,000 calculations in the row. So which scenario will have a better calculation speed? Scenario 1, 30 tabs. The longest tab probably 150 rows calculation. Scenario 2, 2 tabs. Each tab have over 5,000 calculation. Which one will be quicker? Anyone from online? Yeah, scenario 1. So somehow Excel likes shallow tabs, and Excel doesn't mind you have too many tabs. It's actually okay. Maybe user-friendly wise, that's where you always find the compromise between user-friendly and the calculation speed. So if you have 30 tabs and each tab is only 100 rows calculation, the model actually runs really smoothly. But you have one tab have over 5,000 rows calculation, the model just slow down straight away because that's how Excel works. Yeah. So that's where the calculation speed, I always thinking, doesn't matter the model fit purpose, the model is well built, beautiful. But if I had some model before, every time I open the model, I go to get a coffee and come back and run a scenario, go to have a lunch. I just don't think that model will be a good financial model. So that's the three things in my personal view, meet the purpose, user-friendly, and have a good calculation speed. Will basically tell us a good financial model is. So that is my view of the financial model. Someone from online said they can only see what is a good financial model on the screen. That's pretty much what we see as well. Because we trying to, as I mentioned before, I trying to don't put too much wording in the PowerPoint, but more like use the trends to discuss, and share with people. So then 3 key approaches used for business valuation. So this one I'll be very quickly go through and touch base on. So first one is income approach, which everyone knows that one. So income approach is basically try to value a business based on the business income forecast, which the typical one we talk about is the DCF, the discounted cash flow. We forecast all the business future income, and then we discount it to the present value. Another one is a market approach. So the market approach is typical one, the multiple. So basically people will see, okay, if I want to buy a business, I look at a market, what kind of other business which is similar to the current target business I'm valuing. And if they are similar, have they have any transaction recently happened? So if I want to buy a pharmaceutical business, and then I happily know there's a very similar business being sold last year at EBITDA multiple 10 times, that will be a very good price indication for me. So that is the comparable transactions. And another one is comparable companies, which is the one from the listed company. So if we have if I want to buy a small bank, I probably will look at the big 4 banks online, probably not that good comparable because the size, but I still will be giving me some good understanding idea about, okay, so say for example, CBA currently listed, what is the market cap, market price? What is the CBA's enterprise value based on the market cap? And then give me a CBA's EBITDA multiple, and then help me to understand, as a reference track. So that is mainly the market approach. You can do the EBITDA multiple, you can do the price to earning, you can do the revenue multiples. Those are all in the market approach. The last one is a cost approach. So this one in the valuation standard, sometimes people will call it asset approach, but we still call it cost approach. So asset approach and a cost approach are kind of like a little bit normally in the same bucket. So cost approach mainly is talking about how much it will cost you to replicate the business. That's basically the concept. So the cost approach mainly used, I don't think it's that often used for business valuation, but more for the physical asset valuation or software valuation. It's more like thinking, okay, from the cost perspective, how much will cost you to replicate the product or the business? So that one is more building from the bottom up about the cost side. And the asset approach is the one we normally look at the business balance sheet to see what's the net asset and whether the net asset can be recognized as a market value. So those are the three key approaches we use very commonly for business valuation. And the most commonly used one, it is income approach. It's very common we use income approach and we cross-check with the market approach. That's why today, I want to talk about the DCF modeling, because that's where we always, review or using or, analyzed when we're using income approach to value a business. I may quickly pause here. Any thoughts before we move to the core best practice of the one? Okay.
Are you generally sometimes use three of them together?
It's very unusual. In my time in working valuation, almost never for three, all of them using together. Normally we always choose two. One is the primary approach. Another one is a cross-check approach.
Primary would be the income approach, as you mentioned. Generally.
Based on really that one really based on the case by case. Income approach as a primary approach is the most frequent one we encountered with. But sometimes if the client don't have a reliable forecast for the future, we have to choose market approach. And but you're right, income approach as the primary one and a cross-check with the market approach is the most commonly used one. Yeah.
You talk about those business, they are going concern business.
Yes. Or if it's a liquidation scenario, that's a very different valuation method. Yeah. Okay, so best practice for the. Okay, there's an online question asking what are the key parameters we are considering when we choosing the comparable. Trying to not disturb too much from the main topic today, I'll be very, very high level touched on. It really depends on the business you are valuing. So, but mainly it's look at the key value drivers. We look at the business, the profitability, which is like EBITDA, NPAT, and we also look at the size of the business. We always, find comparable companies or transactions in the same industry. That's always the start point. And then we look at the business, high level saying will be the business profitability, the EBITDA, NPAT, EBITDA growth, it's the growth perspective. And then last one is the size. We normally thinking the multiple tend to be, smaller compared for the large size company compared to a smaller size company. The multiple tend to be higher with the company have a strong growth perspective. Obviously, if you are less profitable, you will have a lower multiple as well. It's very high level, but individual companies is always case by case. Yeah. Okay, so the best practice for the valuation one. So it's a DCF model. I want to really talk about its consistency because a lot of times, valuation is always one of the key principles is consistency. So the key ones I was talking about is discount rate should be always consistent with the cash flow. I know it sounds a little bit hard to believe, but we actually see model, they using WACC to discount the free cash flow to the equity or using the cost of equity to discount the free cash flow to the firm. So I always saying, once you're building a DCF model, you want to make sure your cash flow at the end for your present value calculation needs to be consistent with your discount rate. So if you are valuing the business based on the free cash flow to the firm, which is before the capital structure, you should always use the cost of the capital for the entire firm, which is the WACC. You consider both the cost of equity and the cost of debt. If you are doing the free cash flow to the equity holders, which is after your debt-related cash flows, then you always go with cost of equity. So that consistency, I know it's a lot of people say, come on, Ruby, that's the basic, but you'll be surprised. There are times people actually link to the, either they accidentally link to the wrong cell with the WACC, or sometimes they just didn't click to them. The discount rate and the cash flow need to be consistent. Another one is less obvious, is the tax. If you have a post-tax discount rate, you should have a post-tax cash flows. And that one, sometimes people, just naturally just don't think through that. So that's where when you're building your discount rate, you should always consider that consistency. Single timeline for all the calculations. Even these days, we have so many best model practice or standards out there. I still see models have different timelines. They will build a timing sheet as a centralized timing, but in the presentation wise, in some calculation sheet, they will have monthly timeline on top, and then have some calculations, and maybe in row 100, they will have annual timeline and have the annual assumptions below. It really annoys me every time I see this type of model, because it's very hard, a lot of times, people may totally miss the second half, the annual timeline. And sometimes even as a model auditor, if you trace that one, you will see, okay, your top one is a monthly timeline. Why here you have an annual figure? Or then you scroll up a little bit, you see, in row 100, they actually have an annual timeline. So these days, I still see this type of things happening. So I still thinking, you definitely should have single timeline for all the calculations. If it's possible, then you can, always go to the smallest timeline. You go to monthly or quarterly, hopefully not daily. And then, you're building a summary sheet. You can building an annual timeline, sum them up. But overall, you should always try to do the single timeline for all the calculations and a single timeline for per sheet at least, So that's something I always, want to highlight. And to be honest, these days you will see some timeline still have first half of timeline is quarterly and the second half is monthly. It's quite common in the transaction model because the first half of the one is the construction time and the quarterly is sufficient enough. And then they do the operational one, they transfer to monthly. That one is okay, but if I would build it, I still prefer to build a monthly timeline, and during construction time, I'll guide by my quarter number. So the end of the quarter, middle of the quarter, or beginning of the quarter, and I'll just use if function. If that one is the end of the quarter, that's where I pick up the quarter cash flows. Because I just thinking it's easier than, of course, when doing the summary, I'll summarize with the quarter. But overall, I will accept, first half timelines quarterly, second half timelines monthly, as long as you only have one timeline for that particular sheet. I think that's okay. So that's something I found is quite important. Another one is the end of period and the middle of period discounting. Yeah.
Can I ask you, why is that? Why did they do it? Is it because the data collections not complete for the first one? They only got a summary, for example, for quarterly.
Oh, no, it's because during the construction time, like all the, or maybe it's another way around. Sometimes, it's like a monthly in the construction time and a quarterly in the operational time. So the construction time, they may have the S curve about your CapEx spending. So for your CapEx spending, the S curve is normally by the engineer created. It can be each month, how much you spend on your capital project. And also your drawdown of your debt and equity is drawn down at the monthly level. But once you reach to the operational time, a lot of times the debt repayment is quarterly repayment. and their operational forecast quarterly is sufficient enough, that's quite common. They can do that way. And sometimes, it's become like, other way around, quarterly first and monthly later. It's driven by sometimes based on the project performance or project data collection. So there's a lot of like different reasons for that. But yeah, but I can understand sometimes, for the modeler choosing to have the mixed timeline. Like we built some project before, the first phase of the project, everything is based on quarterly, and the second half of the phase of project, once they implemented, everything we get data from the source, it's monthly. But I can understand that one from time to time, yes. But overall, I think it's, yeah, maximum at least have one timeline per sheet. I did see a pop-up, but I missed that question.
The question is, how do you approach the task of estimating firm-specific cost of equity capital?
Oh, that one is really a valuation question. I may park that one for now, because after this whole section, if we have time, we can carry on a little bit that one. Because that one has become more like a valuation thing. It's a little bit disturbed from the main one now. Yeah. End of period and the middle of period. So that's why I think when you're building a DCF model, you probably see that one. Some people will use the middle of period, some people will use the end of period discounting. So for valuation perspective, it's very common to have end of period for annual cash flow. Oh, sorry, my bad. Middle of period for annual cash flow. And sometimes even middle of period for a semi-annual cash flow. But we almost always use the end of period discounting for the monthly and the quarterly cash flow. The whole concept of middle period discounting, it's the assumption we're assuming. So when we have a cash flow, right, say if it's a monthly cash flow, we see the free cash flow to the firm of 100 happened at the end of the month. People will naturally thinking, okay, we're assuming the whole 100 will happen at the end of the month. But you're thinking about if you have an annual model, you will not think the company will have $100 only at the end of the year. There'll be a lot of activities happening during the whole year. So overall, the annual cash flows we use in the middle of period discounting with the assumption is we're assuming the cash flow forecast of the particular year will be evenly spread across the time, across the year. That's the theory behind the middle of the period discounting. We tend to use the end of period discounting for monthly and quarterly. It's because we're thinking the time interval is quite short, so we tend to be okay use the end of monthly. But I just want to highlight the theory behind the middle of period discounting one. If you're assuming cash flow evenly cost, middle period is always good. So if you are really thinking this business is very evenly cost during the quarter as well, you can still use middle period discounting. For middle period discounting, the most common way I see people to do is to have an additional line to calculate the middle period date, which basically is the period end day minus the period start day plus 1 divided by 2. That's normally the people using. In valuation team, we actually use a slightly different way. We are using, this time you'll be good to use that one, but that's okay. We normally use year frag. So we have a year frag to calculating the year frag between end of the period and the start of the period. And for the middle point discounting time, we just use the previous year frag, previous period year frag plus the current period year frag divided by 2. So that's another way to use. But either way, you can, simply use the middle period date as well. That's also work.
I just have a question here.
Yeah. So DCF valuation requires either cash flows to indefinity or terminal value calculation. Which do you prefer? How do you approach the task of either estimating the terminal value or determine or assume the growth rate in cash flow to indefinite? I never see a DCF model will go in indefinite cash flow forecast because I don't think Excel have indefinite cash flow, like indefinite rows, columns for us, if I interpret correctly. Normally, if we consider the business is a going concern, we always will put a terminal value there, which everyone see from the DCF model, unless you think the business, say for example, if it's a toll road, it's a 99 years lease, then you can't see the forecast stopped at year 99. That's some special case, or sometimes renewable project, if it's solar farm, you think the solar farm will be, diminished within in year 30 or year 25, you don't have a terminal value at the end. But most of the time, we will always have a terminal value. For terminal value, there's a two methodology. One is the multiple, one is the golden growth method. The multiple is basically, you can think of, like say, okay, if you're thinking about at the terminal value time, terminal year, you will exit the business as the owner. Then you will able to get a purchase price in the market at, say, if we pick up a terminal year 2040. In 2040, you, as the owner of the business, you're going to sell the business in the market. You are thinking about how much at that time you can get in the form of like EBITDA multiple, for example. If you're thinking you can get an EBITDA multiple, say 10 times of EBITDA, just made up the number, then you will have your terminal value equal your EBITDA at that time times 10. That's your terminal value. Then you discount it back to today's value. Another method is the golden growth method, which is basically you're thinking the business has reached stable situation. We all know the corporation development curve. So once the business reached a mature stage before declining, so the business will reach a more stabilized situation. We're assuming the business will be able to grow at perpetuity at a constant growth rate. And normally we pick up the growth rate, the constant growth rate normally is just the inflation rate, because that's like no business can grow, can outbeat, well, that's the theory. No business can outbeat inflation forever. So that's why we normally tend to pick up the inflation rate. So the golden growth method is basically, you have your terminal year cash flow times 1 plus your stable growth rate divided by your discount rate minus your stable growth rate, which is the variation of the perpetuity present value formula. So basically the concept of the golden growth method is assuming the business will be a going concern, but at the terminal year, the business reaches the stable situation, which means we can use the perpetuity formula to calculating the present value at the terminal value year to represent all the business future cash flows. And then we then use the present value in, say, 2040, discounted back to today's value. That's basically the concept. Is that clear? I need to elaborate a little bit further? Because without the board, it's a little bit trickier, but especially given my accent as well. Yeah.
The terminal value you predict is just based on negotiation or picture to show people, the decision maker, what is going to happen in the future, isn't it? It's not really true, isn't it? Sometimes many businesses even don't know next week what's the cash flow look like. Right?
Yes, I agree. So the terminal value determination, to be fair, in valuation team, I literally, even today, I spend 1.5 hour debate on terminal value things with one of my partners. So when we go into the valuation, if you want to dig into the pigeonhole, you can actually go a lot of discussion, but you are right, valuation is all based on the forward looking. And for DCF model, it's the same, a lot of assumptions we put it in, it won't be, no one has crystal ball. So it's really based on the judgmental call, about the assets we have seen in the market, how much they're being sold, talk with different investors, how much they're thinking the industry will be able to develop in 10 years time, 20 years time. Then we base on some today's data and some economics forecast, which we all know never been accurate, but based on those forecast data to form a professional view of the terminal value multiples or terminal value discount rate.
It won't be right, isn't it? Because the situation changes, the discount rate will change.
Correct. That's where in valuation, which is the next slide I'll comment on. For valuation, there's always a key caveat there. It's in our opinion, the value of company X is Y as at today is the 15th of October 2024. The valuation day is critical for us because, it's the same thing for a house, right? Thinking about exactly the same house. Today we're buying it compared to 3 years ago buying it. The price is different. It's not because the house changed that much. It's because the macroeconomics changed. So the value of the business of the asset will change accordingly. So it's always have the caveats based on the current economics forecast and the current economics expectation, the investors willing to pay X asset today. Yeah.
It also depends on purpose, isn't it? Because I got a question from our client saying that when we should do a valuation for my company. And it is a question important because they want to sell the business to the trust fund, the trust. So it means that generally it should be the lowest value, isn't it?
Well, that one I will not comment on. That one I will
don't
not
want to
comment
pay
on.
tax, isn't it? Because capital gains, isn't it?
That one I will not comment on. So X MPV and X IRR. So for MPV and IRR, I think these days, most of the modelers I have been spoken, they all know we should use X MPV and X IRR these days because instead of use the MPV and IRR formula, because the X MPV and X IRR formula, they will always, there's two key things. So for those formulas, firstly, they automatically adjust the rate to meet your cash flow interval. So if it's a traditional MPV formula, you have to make sure if it's an annual cash flow, you have to enter the annual rate. But for X MPV, you just put the annual rate there, and with all the monthly one, they're automatically adjusting the rate. That's one thing. Another thing is for the MPV formula, they're just assuming the cash flow interval is exactly the same. Yes, normally it's kind of like a similar, but say, for example, if it's a monthly model, some months may be 28 days, some months may be 30 days, some months may be 31 days. So XMPV and XIRR will be able to automatically adjust that as well. So these days, I probably 95% of the model we see are using XMPV and XIRR these days, which is really good. But the one thing I want to quote out is there are a lot of times people have the equity value or firm value calculated and put on the left-hand side and no valuation day on top. That's the one it's always irritated us because we can send a very wrong message. It's about, and sometimes people will have XMPV calculated in cell A2 and the XIRR calculated in cell A3, and they are actually using different valuation date because once they drag the date, the XIRR they drag to maybe, column Z, it's the 30th of June 2024, but XMPV for whatever reason, they actually want to pick up the value for, for asset today. So if, for example, the XIRR is the transaction day, the 30th June 2024, but the XMPV, they want to calculate the value as at today, which is the 15th of October 2024. So they will use different valuation date, but they put those two numbers together without give a valuation day next to it. So that's another thing I was saying. If you're calculating, unless it's a roll forward, unless it's it's a rolling NPV and IRR, people can clearly see the IRR and the NPV on the top of the timeline. Otherwise, if you put in the output sheet or in the reference panel on the left-hand side, please add a valuation date to the NPV and IRR calculation. It's just much more clear. Oops. I think we run out of time a little bit.
Yeah, so we'll aim to wrap up around 15:15. So we go for about an hour.
Okay, okay.
So-
I'm okay. I'm just worried, I think I'm talk too much. Okay, these three, I'll try to be quick. So the one I was talking about before is a TV calculation aligned with the value. So this one, I just gave one example. So for example, I'm currently valuing an equity value. And I decided to use EBITDA multiple for the terminal value because somehow, we found out from a reliable source that we know in 10 years' time, it's very likely the company exit will get 10 times EBITDA. So as a result, they will end up, using an EBITDA multiple to calculate terminal value, but the overall model, DCF, is calculating equity value. So in that case, I see there are situations, people just have the free cash flow to the equity holders plus the EBITDA times 10, and then discounted to today's date, which is incorrect because EBITDA is before the debt-related cash flows. So if you're using EBITDA as a multiple, it will automatically give you an enterprise value. So in order for you to calculate your terminal value to align with your equity value calculation, you need to use your EBITDA multiple calculated terminal value, enterprise value, minus your net debt as at a terminal year. So that's something people just need to keep in mind of that. And same thing another way around, if you are valuing a business, you want to value the enterprise value, which means you're using your WACC, then you just need to make sure for your terminal value calculation, if you're using EBITDA multiple, that's easy. But if you're using, price to earning to NPAT, NPAT is the financial matrix after the debt, after that cash flow, which is the NPAT mainly relates to the equity holders. Then when you're adjusting that back, you need to add back your net debt. So that's the key things, we constantly see people make a mistake. So your terminal value calculation, you always need to keep in mind, the terminal value calculated is an enterprise value or equity value. And what's my overall goal? Do I want to calculate the enterprise value or equity value? So just make sure those ones are aligned. Another one is the ex-dividend and a com dividend. So a lot of times, when we have a cash flow, if the valuation day is on the 30th of June, 2024, and are we gonna include, for the DCF model calculation, are you gonna include the cash flow in the, say, for example, if it's a monthly model, will you include the cash flow in the June 2024 or exclude that? Any idea from online as well? So our valuation date is the 30 June 2024. If it's a DCF model, you calculate the present value as at the date. Will you include the cash flow in the June month or exclude that? You're obviously including all the future cash flows, that's given. But for the particular cash flow happened in the month of the valuation date, will you include or exclude? Any thoughts online? Okay, I'll quickly say it depends. It really depends. That's the concept of ex-dividend and a com dividend. So it's a little bit like, yeah, that's right. It depends. Because it seems like, think about, it's like the share market. If you buy a share, based on your trading day, there's the ex-dividend and a com dividend. So if you know the business, they declare the cash flows, they declare the dividend in June, and they will pay in the June month, then you will exclude them because the cash flow has been paid already in the June month, which then you shouldn't include in this cash flow in your present value calculation, which is the
because double counting.
Yes, because as the value you have as at 30 June 2024, that cash flow is already out of the business. So you cannot calculate, you cannot count that one anymore because you already paid to your shareholders. So you can't calculate the money as part of the value if it's no longer in the company. So that one is the ex-dividend situation. If it's a com dividend, it's sometimes the business will say, I will pay my shareholders $100 dividend in the June quarter, but the actual payment will happen in 2 weeks' time, in the middle of July. That situation, you will including that dividend because that money as a cash still sit in the company, which is the com dividend situation. So that's where a lot of times when we do evaluation, we always will understand the company's dividend policy and how they implement. A lot of times these days, the business, they declare a dividend, then they will basically, pay few months later, then that cash will stay in the company before distributing as at evaluation day, then we will add them as the surplus cash, which is part of the part of the valuation. But a lot of times, in the real DCF model, 85%, obviously 85, it's just like a notional amount. Most of the time, I will see people actually calculating in a DCF model as an ex-dividend. Basically, they will not include in the cash flow in the valuation date period. But this really depends on your assumption. If you're assuming the business will pay the declared dividend in the month, then ex-dividend is right. Otherwise, com dividend, the cash is not out yet. It's still in your business, then you capture that one. So that is the ex-dividend and the com dividend I want to highlight. The last one is the treatment of surplus asset. That one, it's not that commonly used in DCF model. I only see few of the trends. It's more in the output sheet. So sometimes a business, they will have a surplus asset. So basically surplus asset means some asset, the company have in place, but not used for daily operations. So one good example is a company have a side building. No, that's not a good example. So one renewable company, they acquire the land. They're trying to develop a solar farm, for example. But the land was there, but they haven't done anything else. They just happily acquired the land, or the land just sitting there as a vacant land. And they know as a valuation date, even for the next year, they probably won't be able to have the ability or the condition to develop the solar farm on the land, which means the land is sitting there as a vacant land. And that land will not be used by the business to do any normal operations. And in the cash flow forecast, happily, the business didn't put any potential revenue generation associated to the land in the forecast because they don't know the land when they will be able to develop the solar farm. So that land is treated as a surplus asset, and that surplus asset will just sitting there, not supporting any ongoing operations of the business, but also not reflecting in the cash flow forecast. However, it's on the business balance sheet. It's an asset of this business. So in that situation, you will see sometimes, we will see that one. Sometimes we will actually have the one as a surplus asset and being calculated side. And the logic is, if it's an equity value, we will add this surplus asset to the equity value. But we will exclude that one from the enterprise value, which is a little bit counterintuitive because it's a vacant land. It's an asset. You add it to your equity holders' equity value, but you exclude that one from enterprise value. Why? The reason for that is because it depends on the purpose. Again, everything is driven by purpose. For valuation perspective, it's a surplus asset, definitely will be part of the owner's asset, which is the equity holder are the owner of the company. However, we exclude from enterprise value because the enterprise value, most of the time for valuation purpose, we are using that enterprise value to calculate EBITDA multiple. And the EBITDA multiple is basically has nothing to do with that land because your EBITDA generation, it's not depend on the land. The land is not adding any contribution to the EBITDA. So if you including the vacant land into your enterprise and then divide the EBITDA to calculating the EBITDA multiple, you actually inflated your EBITDA multiple because,
What about wouldn't you include, you've got holding costs for that land? At the very least, you're going to have some rates or
but
land tax?
if you have holding costs, etc., then really depends on how your forecast cash flow have including that. Because for DCF, as you can see, for the high level forecast, for that small type of things, they will not put in your cash flow. So basically means that a vacant land is just like the land value sitting there. And sometimes, for what you mentioned, if you really want to go to the particular detail, you can actually calculate in the land value by deducting those costs. But then the land itself still not has direct impact to the business as an overall daily operation. So your EBITDA generated from your daily normal operation. If you add the land to your enterprise value, then divide your EBITDA to get your EBITDA multiple, that EBITDA multiple is inflated. That's where in valuation practitioner, you will see the standard is basically for enterprise value, we exclude surplus asset, but for the equity value, we include the surplus asset for that reason. Yeah.
Can I summarize like that? For enterprise value, because the asset is not income generating purpose. So it means that it's no EBITDA in a way, because you got income and then you got a net profit basically, right? Am I correct?
No, I'm a little bit lost. So basically, I think it really depends on the situation because for the enterprise value, for valuation perspective, we normally calculate the enterprise value with the purpose to calculate the EBITDA multiple.
But the EBITDA is basically the bottom line of income minus cost and then
Correct,
right?
correct.
So it means that the land by itself is not income generating
Correct,
purpose.
correct.
That's the reason. So
Yes.
So for the equity, because it's a value or asset, you got a land at home, which is you're not developed next to you, you purchase at personally.
Exactly.
But that's why you have to include in your asset, isn't it?
Yes.
For tax
correct.
purposes, basically in the asset testing.
Yes,
For
yes.
enterprise with income testing for personal tax
Yeah,
purposes.
yeah. You can think in that way, yeah. Because basically for equity value as equity holder, that's part of your asset you actually owned. That's why we're including that one. Yeah.
Okay, I think we need to wrap it up.
Yeah, perfect.
So thank you so much. For those of you who are joining us online, we will wrap it up. For those of you in the room, we will continue for a few minutes longer and we will reconvene down at the bar next door.
Yeah.
But thank you so much, Ruby. That was very insightful and very helpful.
My
What a
pleasure.
Great presentation style and very informative. So thank you.
No,
very much.
Thanks for everyone, contributed. and join the discussion. That's quite useful as well. Yes. Thank you. And thanks for Danielle for the opportunity as always.
Yeah, lots of thank yous coming through. So I'm going to sign out.
Thank
and
you.
See you again next time. Bye, everyone.
I'll just look at Danielle. I don't know how to do these things.